All right, so let's dive into money market instruments today.
Sounds good.
Whether you're, prepping for some big finance meeting or you're just trying to, brush up on your knowledge, maybe you're just curious.
Sure.
This deep dive is for you.
Yeah.
Today we'll uncover not just the what, but the why of these instruments, how they work, why they matter, even if you know you're not a Wall Street hotshot.
It's interesting to think about how these money markets have been around for centuries.
Wow.
Really, it's essentially where institutions park and move their short-term cash, usually for periods less than a year.
Okay.
You can think of it as the financial equivalent of a high-speed train, constantly shuttling funds between, governments, banks, and corporations.
So this train is crucial for keeping the, global economy running smoothly.
Absolutely. This constant flow of funds allows businesses to manage daily operations,
Right.
invest and create jobs.
Okay.
But here's the catch.
Oh.
The minimums for direct investment are usually sky high, making it more of an institutional playground.
But that doesn't mean that, we everyday investors are left out in the cold, right?
Not at all.
Okay, good.
That's where money market funds come in, offering a way for individual investors to get a piece of the action.
Okay.
But before we get into those, let's break down some of the key players on this financial train,
Okay.
the actual money market instruments themselves.
All right, let's unpack those.
Sure.
I've heard of things like treasury bills,
Right.
but to be honest, the whole thing sounds a bit like alphabet soup to me.
Well, let's start with a familiar concept, cash instruments.
Okay.
Think of money market deposits,
Okay.
those fixed-term accounts you'd see at a bank.
Right.
They offer a guaranteed return, but you're committing to keeping your funds there for a set period up to a year.
So it's like a savings account on steroids, right?
Precisely.
Higher return, but less flexibility.
Yeah, exactly. Now, moving up the complexity ladder, we have repurchase agreements, or repos for short. These are essentially secured loans where you lend out cash and receive high-quality collateral, usually government securities in return.
So it's like a pawn shop, but for big institutions.
Yeah.
You give them cash, they give you something valuable to hold until they pay you back.
That's a great analogy.
Okay.
It ensures that lenders have a safety net,
Right.
while borrowers get access to quick cash.
Makes sense.
Repos play a vital role in keeping the financial system, well-oiled.
Well-oiled. Oh.
Now, onto those treasury bills you mentioned.
Yes.
They are indeed considered among the safest investments out there.
Is that because they're backed by the government?
Exactly. Governments generally have a good track record of paying their debts.
Right.
Now, with T-bills, you don't receive regular interest payments.
Okay.
Instead, you buy them at a discount and receive the full face value at maturity.
So it's like buying a $100 bill for $99.
Precisely.
Okay.
And that difference is your profit because they are seen as almost risk-free. T-bill interest rates often set the benchmark for other rates in the market.
Fascinating. So they're like the gold standard of short-term investments.
You could say that.
Okay. What else should we know about these instruments?
Well, they also play a crucial role in how central banks manage the money supply.
Okay.
For example, by issuing more T-bills.
Right.
A central bank can absorb excess cash from the system, which can help control inflation.
Okay, so it's like a giant financial balancing act.
Exactly.
Now, we've talked about deposits and T-bills, but there's another term I hear a lot.
Yeah.
Certificates of deposit, or CDs.
Right.
Are these the same as the CDs I see advertised at my local bank?
Not exactly.
Okay.
The ones you encounter at your local bank are typically for smaller amounts
Okay.
and aren't designed for trading in the money market.
Right.
We're talking about negotiables or jumbo CDs,
Hmm.
often used by institutions. These can be held until maturity or,
yeah.
and this is key,
Right.
sold to other investors in the market.
So it adds a layer of flexibility that regular CDs don't have. Exactly.
But like with any investment, there must be some risks involved, right?
You're right. Their value can fluctuate based on prevailing interest rates,
Sure.
meaning potential gains or losses if you sell before maturity.
Right.
This is especially important for investors who might need access to their funds before the CD matures.
Got it. It's all about weighing that balance between liquidity and potential return.
Exactly.
What other instruments should we be aware of in this market?
Let's talk about commercial paper, or CP.
CP.
These are basically short-term IOUs issued by large publicly traded companies.
So instead of going to a bank, big companies can essentially borrow directly from other institutions by issuing these IOUs.
That's exactly right.
Okay.
They use these to raise quick cash for things like payroll or inventory like T-bills.
Right.
They mature within a relatively short time frame, typically less than 270 days in the U.S.
And the return is based on buying them at a discount and receiving the full face value at maturity.
You got it.
Now, one final instrument worth mentioning is the bill of exchange. Okay. Imagine a company receiving goods or services,
Right.
but agreeing to pay later. This promise to pay becomes a tradable bill that can be bought and sold in the market.
So it's like an invoice that can change hands.
Exactly. To make these bills less risky, banks can step in and guarantee them,
Okay.
promising to pay if the original issuer defaults. This makes them more attractive to potential buyers.
Okay, we've covered a lot of ground here, so let me make sure I understand the basics.
Sure.
We've got these different instruments, deposits, T-bills, CDs, commercial paper, and bills of exchange,
Right.
all floating around this fast-paced money market.
It is fast-paced.
But how do investors actually make money from them? It seems like there are two main ways to make money in the money market.
Yeah.
Through something called yield and capital gain.
Right. You nailed it.
Okay.
Think of yield as the interest earned on an investment,
Okay.
similar to the rent you'd receive from a property. Then there's capital gain, which is the profit made by buying an asset at a discount and later selling it at a higher price.
So with some of these instruments, you're essentially aiming to buy low and sell high,
Yeah.
while others offer a more steady stream of income through interest payments.
Precisely. And that's how it typically plays out in the money market.
Okay.
Some instruments, like those money market deposits and certain types of CDs, are primarily yield-based.
Right.
They provide regular interest payments over a fixed term.
While others like T-bills and commercial paper rely more on that buy low, sell high strategy.
Exactly. But before we delve deeper into how these instruments can be part of your financial toolkit,
Okay.
it's important to understand the overall risk profile of the money market.
Okay, let's talk risk.
Yeah.
When I hear market, I automatically think of volatility and potential for big losses.
Yeah.
Is the money market really as low risk as it's often portrayed?
Well, it's generally considered low risk,
Okay.
but it's not entirely risk-free. Remember, we're dealing with short maturities.
Right.
And in many cases, high-quality issuers.
Right.
This naturally reduces the potential for dramatic swings in value that you might see in, say, the stock market.
But you're saying there are degrees of risk even within this safe haven.
Absolutely. Think of it as a spectrum.
Okay.
On the safest end, you have those treasury bills backed by the full faith and credit of the government.
Right.
Then as you move along the spectrum, you encounter instruments like commercial paper,
Okay.
which carry slightly more risk because they're backed by corporations, not governments.
So even within this seemingly stable world, there's a need to understand the nuances of each instrument
Yeah,
and its associated risks.
precisely. And that brings us to money market funds,
Okay.
which, as we touched upon earlier,
Right.
offer a more accessible entry point for individual investors.
Okay.
They pool money from multiple investors
Right.
to purchase a diversified portfolio of money market instruments.
Okay, so it's like a one-stop shop for accessing this market.
Yeah.
Without needing to be a financial expert.
That's the general idea. But choosing the right fund requires some homework.
Oh.
You need to look beyond the potential returns and consider factors like fees, taxes, and most importantly, the types of instruments the fund is actually holding.
Okay.
Remember, not all money market funds are created equal.
So a higher potential yield might come with a trade-off.
Yeah.
Potentially higher risk.
Exactly. A fund with a higher yield might be investing in instruments further along that risk spectrum we discussed.
Right.
It's crucial to understand what's under the hood, so to speak.
Got it.
But even with the potential downsides, money market funds can be a really valuable tool
Okay.
for various financial goals.
Okay, I'm all ears. How can everyday investors like myself leverage these funds effectively?
Well, for starters, they're a popular choice for parking an emergency fund.
Okay.
You know, that financial safety net for unexpected events.
Right. Right.
A money market fund can often offer a slightly better return than a traditional savings account, while still providing easy access to your cash when needed.
So it's like a step up from a basic savings account, offering a little extra growth potential without taking on too much risk.
That's a good way to put it.
Okay.
Another common use case is as a short-term investment vehicle. Let's say you're saving for a down payment on a home or a major purchase a few years down the road.
Right.
You might not want to expose those funds to the volatility of the stock market,
Sure.
but you also want them to earn more than a basic savings account. That's where a money market fund could fit in.
Makes sense. You're aiming for stability and modest growth over a defined period.
Exactly. And don't forget about the role they can play in a diversified investment portfolio.
Ah, yes, portfolio diversification.
Right.
The classic don't put all your eggs in one basket strategy.
Exactly.
How do money market funds contribute to that?
By acting as a sort of stabilizer or shock absorber,
Okay.
imagine your portfolio is like a car navigating a bumpy road.
Hmm.
The stock portion might be responsible for speed and acceleration,
Okay.
while the bond portion provides some balance and steadiness.
Right.
But you also need good shock absorbers to smooth out those bumps.
I like that analogy, and those shock absorbers are our money market funds,
Exactly.
helping to mitigate the ups and downs of the more volatile investments in the portfolio.
Precisely. They provide that element of stability and liquidity,
Right.
which can be especially valuable as you approach retirement
Okay.
or if you generally have a lower risk tolerance.
Okay, so we've talked about the potential benefits,
We have.
but I know you're going to remind us that no investment is without risk.
That's true.
What potential downsides should investors be aware of when considering money market funds? So it's important to remember that the value of money market funds, it's not, fixed. It can fluctuate based on things like interest rates.
That's right. When interest rates rise, the value of existing fixed income instruments can decline.
Okay.
Now, with money market funds, this risk is somewhat mitigated
Right.
because they hold a diversified portfolio that's constantly being adjusted.
Okay.
However, it's still a factor to consider.
So it's not like a traditional savings account where your principal is guaranteed.
Exactly. And while it's not common, there's also the potential for credit risk,
Okay.
which is the possibility that an issuer of a money market instrument, like a company that's issued commercial paper, might default on their debt.
So even in this world of seemingly safe and stable investments,
Right.
there's a need to be aware of the nuances of risk.
Absolutely. Informed decision-making is key.
Right.
Now, shifting gears a bit, I think it's worth touching upon how the money market is influenced by something called the yield curve.
Okay.
Have you ever heard of that?
The yield curve, it sounds a bit like something I'd need an economics degree to understand.
Not at all.
Yeah.
It's actually a pretty straightforward concept.
Okay.
And it can give us valuable insights into the health of the economy
Right.
and potential future interest rate movements.
Okay, I'm intrigued. Break it down for me.
Imagine a graph.
Okay.
On one axis, you have the time to maturity
Okay.
for different debt instruments,
Mhm.
and on the other axis, you have their corresponding yields.
Hmm.
What you typically see is an upward sloping curve.
So longer-term debt usually has higher yields than shorter-term debt.
Right.
That makes sense. Lenders would expect more compensation for tying up their money for longer periods.
Exactly. But here's where things get interesting.
Okay.
Sometimes this upward sloping curve can flatten or even invert.
Okay.
This means shorter-term yields become higher than longer-term yields.
Why would that happen? It seems counterintuitive.
Well, it often signals that investors are anticipating an economic slowdown.
Mm.
They seek the safety of longer-term government bonds, pushing up their prices and lowering their yields.
So it's like a flight to safety, but within the bond market.
Precisely, historically, an inverted yield curve has been a fairly reliable indicator of an impending recession.
Wow.
Now, what's interesting is how this dynamic in the bond market can ripple into the money market.
Okay, how so?
Let's say the yield curve flattens.
Okay.
Investors might shift their focus away from longer-term instruments like CDs
Right.
and flock toward shorter-term instruments like T-bills,
Okay.
seeking that perceived safety and liquidity.
It seems like everything in the financial world is interconnected. The money market, the yield curve, the broader economy.
That's a great observation.
Yeah.
It's all part of a complex but fascinating system.
It is fascinating.
And that's why having even a basic understanding of these dynamics can be so beneficial for making informed investment decisions.
It's like having a roadmap to navigate the complexities of finance.
Exactly. And speaking of navigation, I think it's important to emphasize that money market instruments, while valuable, are just one piece of a larger financial puzzle.
So we shouldn't view them as a standalone solution for all our financial needs.
Precisely. A well-rounded financial plan requires a balanced approach.
Okay.
Diversification across different asset classes is key tailored to your individual goals, time horizon, and risk appetite.
It's about finding that sweet spot, the right mix of assets that will help you reach your financial goals while managing risk effectively.
Couldn't have said it better myself.
Well, I feel like we've really explored the depths of the money market today, uncovering not just the mechanics, but also the strategic role it plays in the financial world.
We've certainly covered a lot of ground.
And we have. And hopefully our listeners are walking away feeling a lot more knowledgeable and confident when it comes to navigating this often overlooked corner of the financial landscape.
That's the goal. After all, knowledge is power, especially in the world of finance.
Well said so. Until our next deep dive, stay curious, keep learning, and keep exploring those fascinating connections that make the financial world tick.
Thanks for joining us.